Mahesh Patil is Chief Investment Officer at Aditya Birla Sun Life Asset Management Company. Mahesh, good morning. Great to have you with us here. Thanks very much for you joining us. There is this Goldman Sachs upgrade in terms of their view on India. It's basically calling for a 14% upside at an index level by the end of 2026. Sounds pretty reasonable, right? Given where we are. Although the point is how to play it, Mahesh. I just wanted your thoughts on it. If you've looked at the note, it's nothing not that we don't know and we haven't discussed in terms of the reasons and the sort of thesis which they're putting out. But would you agree?
Yeah. Good morning. So I haven't seen that note, but I think clearly, the optimism is coming in from the fact that we are now seen the period where we've seen last 4 quarters successively. We have seen earnings growth has been weaker. There have been downgrades to earnings. This is the first quarter where we are seeing that the earnings actually downgrades have halted, and we haven't seen any major downgrade. At least the results which have come in for the second quarter show that it's pretty much in line. And as we step into the third quarter onwards into the next fiscal year, the outlook over there on earnings growth looks better. Again, buoyed by a better top line growth, and also a lot of sectors, which especially on the consumption side, the auto sector, because the GST cut would see a boost. So I think clearly, the growth trajectory now at least looking to go back into the double digits is what one is seeing. And the fact that on the global front also we're seeing the talks about the trade deal getting soon. I think expectation is that in the next 1 month, the trade talks with the US should conclude. So that should improve the sentiments. And more importantly, the foreign investors who were kind of selling India last month of October, if you look at, they were net buyers. And clearly also they are also seeing the relative valuation of India is now no longer as expensive as what it was a year back. And that is also helping. So I would say that from here on, I think the market returns should broadly be in line with the earnings growth. Valuations are reasonable, I would say, slightly above the long-term average. But looking at the steady inflow, which is coming in for the domestic investors and with foreign investors coming back, I think the market should do better, at least compared to the last 1 year. That consolidation which has happened has also really meant that a lot of the weaker hands are out. And I think there is fresh set of investors, especially from global side, could come in. So I'm not surprised by the target. I mean, it could be anywhere between 10 to 14% in that range if you take a 1-year perspective.
Mahesh, hi, good to have you with us this morning. So let's talk about high growth companies and the market's way of looking at them. If you talk about the new age space, I mean, and each is charting its own sort of course, right? Nykaa seems to be on a path to profitability. The numbers have been looking better. But if you look at some of the others, I mean, Eternal, Swiggy is still raising more money, perhaps for further investment into the business. So how are you looking at this entire internet space? And now it's a little confusing, right? Because the company that will list today sells eyewear, but even, Piyush Bansal is very clear that they're a tech company at heart. So what do you make of this whole space and the approach to it?
It's interesting. I think in the last couple of years, we've seen now quite a few companies into this new age technology or the so-called disruptors which are there. And that is now, and quite a few of the IPOs recently and more in the pipeline would mean that you will see a lot more options over there in that space. And I think especially when we look at some of these high growth companies, they are coming in from a phase where very low profitability or no profitability. And that's where the initial period is very difficult to value them on a price to earnings multiple or even EV to EBITDA multiple. And that's why we would normally look them at slightly longer term view. We would try to forecast their earnings for the next, say, 5 years, because over the next 5 years, the high growth would translate into decent or stable EBITDA margins and also a reasonable profit for us to really value them on a traditional multiples, whether it's EV, EBITDA or P multiple, and then discount that forward. So on that basis is what we will look at it. Obviously, the competitive intensity also is very important because just like what we're seeing in the quick commerce space, the intensity is still fairly large. and with multiple players trying to boost their balance sheets, that can continue to bleed. So I think that's another factor which needs to be borne in mind, that how the competitive intensity is, whether it is settled. If that is the case, then it's fairly easy to really project the earnings going forward. So this is a space where we would take small exposures, build up a basket, and then watch the progress whether they are meeting these high growth targets, and then progressively build exposure in that space. But again, that's a space which is opening up pretty well, and we've seen good performance on some of these stocks in the last 1 year when the market has been flat. So one can't ignore that sector, and most of the new age companies are good quality names. They are dominant in their space. They are market leaders, and that's what gives us comfort over there.
All right. Hi, Mahesh. Good morning. Good to see you, Ben. What about Lenskart? In a few minutes, we'll have the first rate on that one. Plenty of debate. Great business. Valuations questionable, but great response is what they got. We'll have to see what is going to be the listing price. But any view on this one?
Well, I wouldn't. We have also participated in this IPO. Would not like to comment specifically on the company, but again, good companies, good management, strong market positioning, a significant moat. I think these are the factors which we look at in some of these names. And while the initial valuations would look expensive, it's more about also looking at the promoter, right? If we like the vision of the promoter, his ability to not only play that market, but also to pivot at various points in time to really give a new dimension. And these are some of the things which we can't really kind of encapsulate in the multiples. And those are factors actually which we look at when we look at a company, say like Lenskart or any of these new age companies.
So Mahesh, what's the pivot, if any, if I talk about the overall portfolio call that you're taking right now, as we get through the second quarter earnings? Any more changes? For instance, let's look at consumption, because that's the big hope, right? Second half, that the consumption side of the market will revive in a bigger way. So have you made any pivots to that effect? And if yes, and in which pockets of consumption?
So, yeah, so in the GST cut and the whole change in the narrative, towards consumption, which has been an underperforming sector now for the last more than a year. So that makes it much more interesting for us to look at it and names over there, which and it's also a sector, especially which is underowned in a sense. So within that, I think auto is one sector which has already seen some amount of re-rating and rally, but I think it will still continue. I think the growth rate, what we are seeing in the festive season, if that sustains, though even at a slightly lower rate in the next 2 quarters, I think this is a sector which can still see some amount of outperformance over there. Consumer staples is another sector which is still not, last quarter was not that great, but the real impact of the GST cut will come in the ensuing quarters. And there the growth has been fairly weak. We would anticipate that with the overall interest rate cuts, higher disposable income, one should see a better volume growth across in the coming quarters. And this is a sector, again, which is underowned, so that can be a good contrarian play to play out, where we could also see margin improvement because the commodity pressure which was there last year seems to be easing off over there. That's another, I think, pivot which one can look at. But by and large, I would say that we are, the market, we are not seeing any big tailwinds across the sector. So it will be more a bottom-up kind of a market. I think companies are also reacting more to their financials, whether it is positive or negative. So it's going to be more stock-specific rather than taking any large sectoral call at this point in time.
Okay. All right. Fair enough. Some more of a bottom-up approach. Got that. Mahesh, good conversation. Thank you very much for joining in. You have a good day, and we look forward to connecting again soon.